Mike Clossy from the Oregon Forest Resources Institute, and it's my pleasure to introduce Amy Yonke, Executive Director of the Oregon Small Woodlands Association, who will be our host for this afternoon. So welcome, Amy.
Thanks so much, Mike. I welcome everyone to Oregon Small Woodlands Association Forestry Taxation webinar series. This is the fourth in a series of 7 webinars to help you learn all about forestry taxation and how it relates to your property. Last time, Clint Benz covered recognizing income, and today, Clint will cover deducting expenses. The handouts, slides, and videos from previous webinars can be found on our website, and I'll make sure to share the link in the chat for you. If you have any questions throughout the webinar, make sure to use the question and answer tab located at the bottom of your screen. And with that, I'll hand it over to Clint.
Well, welcome everybody. It's good to have you back. For those of you who haven't attended the prior webinars, welcome to this session. Many of the things we're talking about today are going to draw on our second course, which was on classification of how you're taxed or how you're treated as a taxpayer. And so if I'm talking about classification versus personal use or investor, trader business, those kinds of things, if any of those concepts are confusing, or you want to know more about what category you fit in under, I would recommend going back and pulling up that webinar. And again, it's on the OSWA website, and you can look at the video. You can also get the materials, the handouts for that. And so with that, let's go ahead and start today's session. All right, so again, the 7-week session, we've had 3 now. Overview of timber taxation, and we talked about deducting casualty losses. The second class was on how you are classified, determines how you're taxed. As I said, we're going to be leaning on that one heavily today. Last time we talked about reporting income. Today we're going to be talking about deducting expenses. So these are going to be the ongoing operating costs. Next time we get together on the 27th, we'll be talking about capital expenditures. So next time we're going to be talking about things like basis and depletion, reforestation, roads, and then purchasing equipment and depreciation, all that. So that's all going to be next time. What we're talking about today, though, are your operating expenses and what can be deducted. Then on May 11th, we'll be talking about choosing a form of business. And then our last session will be on property tax and harvest tax programs. So today, we've broken this class today into basically 3 parts. The first part are costs that everyone can deduct, no matter what type of taxpayer you are, what your classification is. The second, and those are going to be our harvest costs and our sale expenses. So everybody can deduct those. And then we're talking about costs deductible based on how you're classified. And those are your carrying costs, your development costs, and costs related to the residents on the property. So many of us have rentals or vacation homes or something on our property that get rented out or not. And so if they're rented out or not, how do we deduct those expenses? And then finally, we're going to talk about costs that are only deductible by trader business taxpayers. And those are repair and maintenance costs, the home office deduction, mileage and vehicle costs, and then other operating costs. So I find the repair and maintenance issue is one that the IRS issued 300 pages of regulations on this back in 2014. This is an issue where a lot of people are having challenges on, getting through this. So we'll do a really high level look at that. Home office deduction is important for many of us. We'll talk about mileage and vehicle costs. That's also something that's confusing for a lot of people. And then our various operating costs. So with that, let's go ahead and get into this. If you have your handout, I'm starting on page 3. So harvest costs. Now, harvest costs only relate to the sale of logs, right? Because you can't have a harvest unless you're actually cutting the logs. So if you sell the standing timber, The harvest costs are going to be borne by the person who buys the timber from you. So you sell it on the stump, that means the buyer is going to go in, build the road, cut the trees down, put it on the truck and haul it to the mill. So what are harvest costs? So these are the costs to build temporary roads, the skid roads. And a temporary road is a road that is put in and then after harvest, it's taken back out again. So you basically, you water bar it, you plant over it, and the road goes away. So those kinds of roads are built into harvest costs. If you put a permanent management road in, that is not part of your harvest cost. Those are road costs, which we will talk about next time. So what do we do with roads? But if we're just building skid trails and things like that, those are harvest costs. Obviously, the cost to fall the timber, the cost to move the timber to the landing, processing that fallen timber into logs, a marketable length, then loading the logs onto the log trucks, hauling the logs into to the buyer, which is usually the mill, but it could also be a sort yard. So those are the harvest costs. The harvest costs of getting the trees knocked down and cut into lengths and hauled to the mill. Harvest costs can also include harvest taxes. And so it depends if you're not a business, in deducting your costs as a trade or business, then you want to put those harvest taxes up with the harvest costs. And in fact, you'll want to make sure that you get those taxes paid in the same year as you do the harvest, which means you may have to make an estimated payment or something to get that paid before the end of the year so that you can actually deduct it in the year against your timber income. So again, as we said last time when we're recognizing income, if you're a personal use, so if you're logging trees off of your residence, or you're an investor and you're logging off of ground that you're holding as an investment, then you net those logging costs against the log income that's reported as other income on the front page of your 1040. If you elect Section 631A to report the sale of timber as a cutting or exchange, then the harvest costs get deducted as a cost of goods sold on Schedule C, or if you're a business taxpayer, you're filing an entity form, it gets reported on the cost of goods schedule for the entity form. And we just want to remember that if you are logging off of what your personal residence and you're not treating it as an investment, you want to treat it as part of your principal residence, then you cannot report a loss from the sale. So if your harvest costs or these other costs we're going to talk about exceed your income, you can only deduct up to the amount of the income. So you can't report less than zero. If you are an investor, you can report a loss. Let's talk about sale expenses. So you can have sale expenses whether you sell logs or you sell the standing timber. So what are sale expenses? So these are all the costs to market and to sell either the standing timber or the logs. So if you have to do a cruise to establish the volume and quantity of the timber that is going to be sold, that's a sale expense. You can deduct that. If you do a cruise to develop a management plan, and it's a cruise of the whole property, not just of the sale, then that's not going to be a sale expense. It's going to be a management cost. So it's not deductible as a sale expense. It's deductible as a management expense. And we'll talk about those in a little bit. So the cruise, the survey cost, again, to determine the boundaries of the sale. If you're doing a survey just to determine the boundaries of the property to help you manage the property, then that's not going to be a sale expense. But if you do a survey to mark out the area of the sale, making sure that it doesn't go across the property line, then that would be a deductible sale expense. If you go in and you mark the timber, send somebody in to mark timber to be sold, any cost to scale the logs. And then if you pay a consultant to either market the timber, put together a timber sale, or an account for the sale proceeds. So many times you're hiring a consulting forester, they're going to market the timber and maybe charge you a percentage and maybe they're going to take all the income and then pay the expenses and then send you what's left over. That would be a sale expense. That would be part of the sale. And of course, your travel expenses to monitor the sale would also be a sale expense, assuming that you can deduct the travel expenses, which we'll talk about when we get to mileage and vehicle costs. So again, if you're an investor or a personal use, then you would net your sale expenses along with your harvest costs against your log income on the 1040. If you're selling the timber, standing timber, then you would add this sale expense to your depletion deduction on your Schedule D. So if you're a personal use or investor, you're going to go on Schedule D. If you're selling the standing timber, these sale expenses would be added then to your cost basis of the timber on this capital gain form. If you're electing 631A, again, the sale expenses would be deducted as a cost of goods sold along with the harvest expenses. And just a reminder again, if you're a personal use, you're selling off your residence, you cannot report a loss on the sale of what is called a personal asset. All right, let's go to page 4. Now, so those were the costs, those two costs, sale and harvest costs are deductible by anybody. This next group, what we're going to talk about are costs that are deductible based upon your classification as a taxpayer. And so we'll kind of look at each of these and look at how each different classification can deduct it. So property taxes. If your personal, if this property, this timber is on your residential property, or if you're an investor and you're holding this property as investment, you're deducting your property taxes on your Schedule A. And so property taxes are deductible on Schedule A, but right now, based on with the Tax Cuts and Jobs Act of 2017, for tax years 2018 through 2025, we have a $10,000 limit on state and local income taxes. So that's your state income taxes and your property taxes. So the total of your state income taxes and your property taxes, you can't deduct more than $10,000. So that's capped for federal purposes, but for Oregon, the full amount of the property taxes are deductible. So that $10,000 limit does not apply to Oregon. And so those can flow through. I believe that is correct on Oregon. Anyway, so you're limited to $10,000 for federal. Now, with carrying costs, we have an annual election for investors. It's a code section 266 election. I've got the regulation up there, 1.266-1C2I. This is an annual election that an investor can make to capitalize these costs rather than deduct them. And so if you can't deduct it, then you might want to choose to capitalize it. Now with you, we can capitalize it, but it has to be capitalized based on what it is. So property taxes are on the land. Remember, our timber, at least right now, is not on the tax rolls. So your property taxes are for the land and the buildings if you have improvements on the property. And so if you choose this election, then you would add the property taxes that you're capitalizing to your cost basis in the land or the buildings pro rata based on the amount of tax that was applicable to each thing. You make this election by filing a statement with the return saying, I'm making this election to capitalize, and then the following carrying costs, and you then list them under this regulation. Mortgage interest. If we're a personal use taxpayer, so if this is based on your personal residence, again, the Tax Cuts and Jobs Act of 2017 limited the amount of interest that can deduct on a mortgage to a mortgage of up to $750,000. So if you take out a $1 million mortgage, only 3/4 of that, 750 divided by the million, 3/4 of it only 3/4 of the interest would be deductible. The interest on the amount over $750 would not be deductible. That also applies to new mortgages and refinances. And so if you refinance your home loan and it's more than $750,000, only the amount of the mortgage up to $750,000 is deductible, and then the interest on the amount over that is not deductible. And you just figure that out on a pro rata basis. So that is deductible on, again, Schedule A for if you're personal use, if it's part of your residence. If you're an investor, you don't deduct it as mortgage interest, even if the interest is on your principal residence. So if you borrowed on your home to buy another piece of property, you deduct it on Schedule A, but rather than deduct it as mortgage interest, it's deducted as investment interest. And investment interest is only deductible to the extent of your investment income. And so if you borrowed money on your house to buy a piece of investment property, you basically have to take that amount of the mortgage. So let's say you put in a new $500,000 loan against your house to buy this other property. That the interest on that loan would not be treated as mortgage interest; it would be treated as investment interest. If you took out if you refinance the thing and you took out, so you refinanced for $700,000 and you took $500,000 of that money to use it to buy another property, then you would take that $500,000, the interest on that part of the loan, and that would be investment interest. And so you're required to trace it through to the investment, and you don't deduct it as mortgage interest. That means you can get up over the $750,000 limit and deduct it, but it's deductible as investment interest. So what is investment income? So what is the limit? So investment income is basically your interest and dividends and your rental income. So that's your investment income. You can make an election to treat capital gains and capital gains dividends as investment income. But if you make that election, then those capital gains and the capital gains dividends are taxed at ordinary income tax rates, not at capital gain rates. So again, this is something you do annually. So your investment interest is limited to expense, is basically limited to your investment interest income. There's a schedule on the tax return where you put in your investment interest income, and that it shows, it then computes the limitation for you. Again, if you can't deduct all the interest, you can choose to capitalize it on an annual basis. So there's an annual election. So 1 year you can do it, another year you not. And it's the same election as you do with the property taxes. So again, this is an election for your carrying costs. Now, if you're a trade or business, you just deduct it as an operating expense, as interest. There are some limits for trade or business. I've got those listed on page 5. Again, the Tax Cuts and Jobs Act, and then amended by the CARES Act, limits some business interest, but it's really only for the big companies. So if you have more than $26 million of revenue, then there's some limitations that are put on the interest deduction. So if you're under $26 million, which I guess that most of us are that are on this seminar, then as a trade or business, you can deduct those costs. And again, as a trade or business, you can also deduct the property taxes. So if you file a Schedule C, or if you're an entity, business entity, you're a partnership or an S corporation or LLC, you would deduct those as operating costs, the property taxes, and the mortgage interest. So even if you have a Schedule C, you deduct the property taxes and the interest on the Schedule C rather than on the Schedule A. So that gets you out of that $10,000 limit for property taxes, and you don't have the investment interest limit or the $750,000 mortgage limit on the Schedule C. So again, being a trade or business is a good thing because it basically gets us outside of those limits that personal use people and investors have on those deductions. Property insurance and routine property costs. So these are things like road repairs, cleaning ditches, so your routine maintenance of the property itself, not of your equipment. and it wouldn't be things like pre-commercial thinning and other things. So this is just kind of your routine, keeping the property up types of costs. So your property insurance, which would be, you know, for fire, theft, liability, those kinds of things, and insurance on the timber itself. If you're a personal use, if this is on your residence, those things are not deductible. If you're an investor, that's a 2% miscellaneous itemized deduction, which means a deduction, you don't get a deduction unless the total of those miscellaneous itemized deductions exceed 2% of your adjusted gross income. And only the amount that exceeds 2% are deductible. However, right now, under the, again, the Tax Cuts and Jobs Act, those 2% miscellaneous itemized deductions are eliminated for tax years 2018 through 2025. And so we don't have those deductions. And so the only way that you can get those deductions for the property insurance, routine property costs, if you're an investor, is again to make that annual election under Code Section 266 to capitalize that insurance and those property costs. Now, these might, if they're attributable to the timber, to the extent that those costs are attributable to timber, they would be added to your cost basis in the timber. And to the extent that they were applicable to the land, it would add to the cost basis in the land should you choose to capitalize them. Then again, as a business, you can deduct them as an operating cost on either the Schedule C or the your entity tax return. Development costs. So development costs are different than routine maintenance. So development costs are basically non-capital expenses that are related to the development or the improvement of the property. So these are things like pre-commercial thinning, in timber stand improvement, fertilization. So these are costs, but not reforestation or fencing or road construction. Those are capital costs. So these are non-capital costs, TSI, pre-commercial thinning, fertilization, things that are maybe if you've got your you've done your reforestation and now you're doing bud capping, you're doing other things that are not they're not reforestation costs. They are costs to improve the vigor and growth of the stand. So those are all development costs. If you're a personal use taxpayer, if this is happening on your property, then you add it on your residence, then you add these costs to your cost basis. And either the land or the timber, generally these costs are related directly to the forest. And so these would be added to your basis in the timber. If you are doing this for reforestation or for pre-commercial timber, then it doesn't get added to your depletion basis. It gets added to a reforestation account, which we'll talk about next time. If you're an investor, these development costs are 2% miscellaneous itemized deductions, which were eliminated under the Tax Cuts and Jobs Act. But the difference here is that while these are carrying costs, these development costs are treated differently than just kind of a routine maintenance. If you want to capitalize these costs, you have to make a permanent election, and there's a different reg. It's 2661C2 II. And this is a permanent election. You do this, once you make this election, then basically every time you have these costs in the future, you have to capitalize them. And so if you think that the miscellaneous itemized deduction is going to come back, which it probably will, you may not want to capitalize those costs or make this capitalization election unless you don't mind having it thrown into your depletion. All right, so an investor, it's 2% miscellaneous itemized deduction. When they come back, so right now we don't have those types of deductions, we can't take it. That miscellaneous itemized deduction is taken on Schedule A when it comes back, or we can make a permanent election to capitalize them, and then all years in the future, whenever you have these types of costs, then you're required to itemize or to capitalize them. You would not be able to itemize them in a future year. Again, if you're a trade or business, you just deduct these costs. So timber stand improvement, pre-commercial thinning, fertilization, bud capping, all that kind of stuff is just deductible as an operating cost if you're operating as a trade or business. Again, you deduct it as a Schedule C if you're an individual, or on the entity return if you're a business. All right, so the last section here on costs that are deductible based on your categorization is residences. I devoted some time to this because this is a challenge, and I think many of us have a residence on the property that we're either renting out, we're living it as our principal residence, or we're using it kind of as a vacation home. Sometimes it might even be employee housing. So it might be a place where an employee lives. So how do we deduct it for all those different purposes? So if the residence is a personal residence or a vacation home, so something you're using a vacation home, then only the property taxes and the mortgage interest are deductible. Those are the only costs are deductible. If it's owned inside of an entity, a partnership or an LLC, or an S Corp, then the expenses are, all the expenses related to this are non-deductible. So the property taxes and the mortgage interest can be passed out to the owners as a separately stated item so that the owners can deduct it on their Schedule A as property taxes or mortgage interest. But all the operating costs for the residents are not, just like for your own house. You can't deduct your utility bills and all that for your own house if you own it personally. So it doesn't matter if it's on the property or not. If it's inside of an entity, since you can't deduct it, the entity can't deduct it. And so, but it can pass out those the property taxes, the mortgage interest, so that the owners can deduct it. So that's if it's used as a vacation home or as a personal residence. If it is treated as a rental, then it gets reported on Schedule C. A Schedule E as a rental property, or on the if you're an individual, or the Form 8825 if you're an entity. So if 8825 is the rental income schedule for entities, the Schedule E, page 1, is the rental schedule for individuals. So rental activities are passive by definition, and they're not subject to self-employment tax. And so rental activities, if you're drawing Social Security, rental activities will not reduce your self-employment, or will not create a problem for your Social Security income. And if you have income from the rental, it's passive income that can offset other passive losses. If you have a loss from your rental, it's only deductible to the extent that you have passive income from other sources. Otherwise, the passive losses get suspended and carried forward. We talked about that last time when we talked about recognizing income. So let's go to the steps. So it's not a residence that you're living in all the time. It's a vacation home. So what happens if it's a vacation home? Well, if it's rented less than 15 days a year, so if you rent this basically for up to 14 days, the property, and you live in it the rest of the time, or you use it and maybe it sits vacant a lot, but it doesn't matter kind of how much you use it. But if you rent it for less than 15 days, the property is considered a personal residence. In this case, the income is not taxable and the expenses are not deductible. So it's kind of a special rule. If you rent it less than up to 2 weeks, you don't have to report the income, and the expenses are not deductible for operating the rental. However, the interest and the property taxes are deductible, again, based on the personal rule. So if you own the property in your own name, you would just deduct it on your Schedule A. If you own it inside of entity, you would report the interest and the property taxes out to partners so that they could deduct it on their own income tax returns. This next point is really important. If the property is rented out and the personal use is more than the greater of 14 days, so you rent it more than 14 days, or 10% of the total days you rent it to others at a fair price. So if your personal use is more than that, more than 14 days or 10%, then the property is considered a personal residence. So, and the reason why we care about why, if it's a personal residence, you can't deduct rental expenses in excess of your rental income. So if you use the property yourself more than 14 days or 10% of the total days it's rented out, whichever is greater, then it's going to be considered personal residence, and your expenses are going to be limited to your income. So you can't deduct a loss. So let's look at this. So is a property rented over 15 days? So it is considered, it's a rental. So if you rent it more than 14 days, all the rental income is taxable. And the deductible expenses for operating the rental, which would include all your operating costs, they are prorated based on the days you rent it out to others versus the total days it's occupied. So if you rent it for 3 months and you occupy it for 4 months, so it's total. So you live in there for a month, and then the other 3 months is rented out to others. So 3/4 of the time it's rented out to others, and 1/4 of the time it's being used personally. You're using it more than 14 days yourself, because you're using it for 30 days, and so it's considered a personal residence. And so in that case, but the deductible expenses, you're only going to be able to deduct 3/4 of each of those various categories of expenses. You rent it out 3/4 of the time that it was in use. And so you have to prorate each expense 3/4. 3/4 is deductible business expense, 1/4 is a personal expense. And so the pro rata portion of the deductible expense, so that 3/4 of the rental expenses that are based on the time that it was rented out to others, you can deduct that against your income in the following order. First, you deduct the interest, the property taxes, and the casualty losses. Again, 3/4 of those things. And then you deduct all your operating expenses other than depreciation, and then finally the depreciation. The important thing here is expenses in categories 2 and 3 can't be used to produce a loss if the property is considered to be a personal residence. And so that's where we go back to this rule. If the property is rented to others and the personal use is greater than 14 days, then it's considered a personal residence. So if it's not a personal residence, if you rent it out 100% of the time, it's a rental full on, then 100% of the expenses are deductible, because the pro rata is the days rented, the days occupied are the same number, so it's 100%. And then because it's not a personal residence, you deduct the interest, property taxes, operating expenses, and depreciation, and it can develop a loss. And if it's a loss, then it's a passive loss. You have to have other passive income in order to be able to deduct the loss. But if you don't have enough passive income, that loss then carries forward for future years. All right. A lot of us now are doing short-term rentals. So rather than going out and finding a tenant, we're going to Airbnb or vacation rental by owner, Vrbo, and doing short-term rentals. So if the rentals are short-term, this is not a rental activity anymore, it's a trade or business. And so it's reported not on Schedule E, but on Schedule C. And so what do we know? And it's subject now to self-employment tax, and it's trade or business income. And so if our rental is short term, and how do we determine that? So there's a 7-day rule and a 30-day rule. And so basically you look at the average length of stay of all the people that were in the rental for the year. So you take, so one person was there for 3 days, another person was there for 3 months. You've had 2 people. One person was there for 90 days, one person was there for 3 days. So you've had 93 days of occupancy. You divide that by 2, you come up with what, 46 days is your average stay. And so that's more than the 7 day, it's more than 30 days. So the 7-day and the 30-day rules are on page 7 and 8, or page 8, excuse me. And so, if your average stay is 7 days or fewer, then it's a short-term rental. If your average stay is 30 days or fewer, it's a short-term rental if you provide significant personal services, and that's like cleaning, changing the linens, maid service, things like that. So if you're providing those services, then it's a business, not a rental. Or the other one is, even if it's a long-term rental, if you're providing extraordinary personal service, personal services. So basically you're operating like a hotel. You know, the person is there a long time. So they maybe they have an annual lease, but you're in there every day with maid service. You're you're turning down the sheets, the beds, and so you're providing extraordinary personal service. Then it doesn't matter if you have a short term, the 7 days or 30-day rule don't apply. You're still in this. You're treating this as a business rather than as a rental. If it's treated again as a business, not as a rental, it gets reported on Schedule C. If you're an entity, it gets reported on page 1 of the return as income. Now it's a business. And so the question is, do you have material participation in the business so it's passive or active income? If you're doing this on your property, you can aggregate this business with your tree farm business in order to aggregate to get the hours up. So you take the hours with this business and your tree farm business and add them together to meet the material participation rules that we talked about last time. Okay. So those are the costs that can be deductible based upon your classification. Let's look now at costs that are only deductible if you're in a trader business. So investors and personal use taxpayers can't deduct these costs at all. They're just lost. And in fact, since these are not development costs, they can't be deducted. They can't be capitalized either. So repair and maintenance. This is a big issue. So sole proprietors, business entities, and rental property owners can deduct expenses for repair and maintenance of their property and of the equipment on the property. So the IRS adopted like 300 pages of regulations back in 2014. And so they gave us a lot of definitions and basically fairly substantially limited, in some cases, they really limited what we can deduct for repairs and maintenance. And otherwise, they gave us some boundaries, what we can and can't do. So it's overall, I think it was good. This was an area that had a lot of abuse and that IRS was constantly litigating this. And people really, when they went under audit, they really, what is the difference between a repair and an expense that needs to be capitalized? And so this is very clear now. So repair is it's the cost of keeping the property in good working condition without increasing its value or prolonging its useful life. So if it's keeping in good condition without increasing the value or prolonging the life, then it's generally deductible. We have 3 kinds of costs, repair and maintenance costs, that are not deductible. They are required to be capitalized. And we call them the BRA, the B-R-A, betterments, restorations, and adaptations. So what are these three things? Betterments, restorations, and adaptations. And again, I'm flying at about 30,000 feet over 300 pages of regulations. And so this is something you have questions on. You really need to talk to your tax professional about it to, get some help here. So what is a betterment? So a betterment is basically one of four things. So either you're fixing a pre-existing defect when you bought the property. So you bought the property or the piece of equipment. And when we say property in this case, we mean both real property and equipment. So it's going to use this word property, but basically property means, real property and equipment. So let's say you bought it and you knew it had a problem, or you discovered the problem after you bought it. It's like we bought a cat, a used cat, and we realized that the frame was cracked for the roller. So we had to basically get a new frame underneath, a new frame and rails. So that was a pre-existing defect. Whether we knew it at the time or not, fixing that pre-existing defect is a betterment. It's not a repair. It needs to be capitalized. Also, if you have a manufacturing defect, so the thing breaks, manufacturing defect, and maybe part of it's covered by warranty, part of it isn't, but it just breaks because of some defect in its manufacturing, that is also a betterment. If you enlarge or expand the property so it has more capacity, so you take a barn and you add on to the barn and add on a new section, or so you have more capacity in it, that is a betterment. Or if you basically rebuild it and you improve its quality, its strength, its efficiency, or its productivity. So you're not putting it back to its old state, you're putting it into a new state. Quality, strength, efficiency, productivity has been increased, then that is a betterment. Any one of those four things, if you do that, it's not considered a repair. It's something that needs to be capitalized. Restorations. This is one of the more challenging ones for us. And I think most of the time we're dealing with in repairs, we're looking at the restoration rules. So a restoration, if you restore deteriorated property to its ordinary efficient operating condition, then that's a restoration. It needs to be capitalized. So if you let something go too far, so it's completely broken down, and then that can be a restoration. If you replace a major component or a substantial structural part. So let's talk about that. So you put in a new motor, or you replace a transmission, or you put on a new roof. So that's a major component of the property, or a substantial structural part of the property that you've replaced because it's broken, or something bad happens. The windstorm breaks something down, or motor blows up. You replace that major component, that is a restoration. It's a capital cost. If you rebuild the property to like new condition, so you take it all the way, so you basically replace everything, you take it back so it's a like new. So you rebuild the motor rather than replace it. That's a restoration. Or if you do something with the property that results in you being able to take a casualty loss, or you get a deductible loss from it, that's also restoration. Now, one of the challenges here, one of the issues, actually it's a good thing, is because especially if you have to like replace a major component or a substantial structural part. So if you have to replace a component, that replaced component, if there is any basis left in it, that can be written off. This generally comes into play when we have to replace a roof. So when we buy the property, it's got a roof on it, right? So we buy this thing and it has a roof on it, or maybe we construct it and we construct it with the roof, or maybe we've replaced a roof before. But whether or not the property had the roof on it before we built it, part of the cost of the property is for the roof. And so we can go back, if we still have cost basis in this, we can allocate what we paid for it between the building and the roof. And so let's say the roof is, we paid $100,000 for this house, and the roof was, of that 100,000, the roof is worth $20,000. And we've now depreciated it down. So we've depreciated half of the property. So now instead of $100,000, we have $50,000 of basis left because we've written off $50,000 through depreciation. So the roof part of that went from 20,000 down to 10. And now we put on a new roof, and it costs us $30,000 to put on a new roof. So that new roof, that $30,000 new roof, we have to capitalize, and we have to start depreciation over just on the roof. So we can capitalize that new roof, and it's going to be either 27 and a half or 39 years, depending on whether it's a rental property or not. And so we're going to capitalize a new roof, but we can write off the old roof. So we have $10,000 of basis left in the old roof, and we can write that off in the year that we dispose of the old roof without having to pick up any income for the depreciation that was applicable to the roof. So we can take a $10,000 loss on the part that was replaced. Same thing is true on a truck or some other piece of equipment that we replace a major component. If we have basis left in the item, in the property, we can allocate, again, what is the component's value compared to the total when we bought it, and we can take then that part of it and we can write off the undepreciated basis that's left in that major component. The last thing in repairs and maintenance is adaptions. So this is a change in how the property is being used. So an adaptation would be like you convert a factory into a showroom. You change the use of the property. Or we change a barn into a shop, right? So we change how the property is being used. And so any cost that's adapting that unit of property, the barn or the building or whatever it is, when we bought it to do one thing, and then we spend money on it to change it so we can use it for a different use, something that we didn't, that was not consistent with how we used the property when we bought it. So that's considered an adaptation, and those costs also have to be capitalized and depreciated. So routine maintenance costs are not are deductible. Routine maintenance costs, we don't have to have a safe harbor. So like you replace the oil in the vehicle. You replace the oil in the vehicle, that's a routine maintenance cost. Those are deductible. And so we have 3 safe harbors that the IRS has given us. And we actually have to make an election on the tax return for these safe harbors. And so the first one is what they call a small invoice safe harbor. So if the line item, so you get the bill from the shop and it had 5 line items on it, any of those line items that were $2,500 or less, we could deduct. If the line item was more than $2,500, then we can't deduct it. Or if we don't have a line item, we just have an invoice. If the invoice is less than $2,500, then we can deduct it. Again, we have to invoke the safe harbor, attach a statement to the return saying we're electing the safe harbor for repair costs, and there's a reg and all that goes along with that. So the first election is for the small invoices, $2,500 or less. We can deduct those. The next one is small projects. So if the total amount that you paid on the repair, no matter if it was a betterment, a restoration, or an adaptation, if the total that we paid is the lesser of $10,000 or 2% of the unadjusted cost basis. So again, that unadjusted cost basis is what we originally paid for it. We don't look at depreciation. So if we paid $100,000 for the building, 2% of the cost is $2,000. And so it's the lesser of 2% of the basis or $10,000. So if we spend the lesser of those two things, then we can deduct it. And then routine maintenance costs. So these are things that the repairs are for regularly recurring activities, things like oil changes or changing out the wipers, or it can be paint, it can be new carpet, it can be other things like that. So it's routine maintenance where it's a regularly occurring activity. The repair results from wear and tear of being used in the business. So it's a routine maintenance on something because it's wearing out and we're doing this repair. It's a regular recurring thing. So all four of these things have to be true. It's regularly recurring. The repair results from wear and tear. It's necessary to keep the property operating efficiently, and it's necessary more than once during the life of the property. And so when we talk about the life of the property, it's the depreciable life of the property. And if it's a building, then it's 10 years. So if we have to do that repair more than once, we would normally expect to have to do the repair more than once within that 10-year period, then it can be classified as routine maintenance. So repairing a roof, generally it would not be this, because generally we wouldn't have to expect to repair a roof more than once during a 10-year period. So generally a roof will last 15, 20 years without having to be repaired. So that's repairs and maintenance. Challenging issue, something we have to, and so your accountants, if you're using an accountant, they're gonna, when you give them the repairs and maintenance costs, they're generally asking you to give them the detail so they can look at it and go through these things and call out things for you, and maybe they're asking you for more information on these different types of things. If they're not doing that, then they're not doing their job, and you need to ask them about it. Home office deduction. This is in IRS publication 587. All the details on this, again, I'm going to hit it at a pretty high level. The home office deduction is something, if you use your home, a part of your home exclusively and regularly, and it can be a separate room, or it can just be a space. It can just be a corner in a room. As long as that space is used exclusively for the business. So it can't be the den and you do your work there, but also the TV's there, and it's where the people come in and they watch TV and they do other things. So it has to be a space just for the business. It can't be, you can't use it part of the time for business and part of the time personally. It has to be just for the business. But if you have a space like that in your home, an office or a corner that it's where your desk is, it's where you do your work. And in fact, and so generally they say it's used exclusively and regularly for your business. So they talk about, you meet customers there, you do other work there, but you don't have to meet customers or vendors and other people there. If you're using this place exclusively for your administration and management activities. So you don't have another office someplace else where you're doing your administrative work and your management activities. So if you can do some of that on the road, you can do it in your car, but you don't have a fixed place where you do other things. So if you're doing all your administrative work, your book work, all that kind of stuff at your desk, then and it's only used for the business, then it can qualify for the home office deduction. There's two methods for doing the home office deduction, what we call the simplified method and the actual cost method. If you only use the space for part of the year, so then you have to prorate the cost. So if the business only operates for 3 months out of the year and it doesn't operate the other 9 months, then you can only take 3/12 of the cost as a home office deduction. So the simplified method is simple. You just take the area that's used regularly exclusively for business, not to exceed 300 square feet, and you multiply that by $5. So it's just the area you use in the home, you multiply that by $5. The home office deduction can't exceed your net income from the business. So you can't take your income below zero with the home office deduction. But if you have income on the Schedule C, then you can reduce that down to zero with the home office deduction. The home office deduction is deducted on Schedule C. Again, this is a personal deduction, so it would be something on the Schedule C. You elect that simplified method annually just by using it to compute the deduction. So you just you fill it out. There's a form for the home office deduction, and you just take the space times $5. That's how you do it. If you don't have any carryover of unused deduction, so let's say you have 200 square feet times $5 is $1,000, and you only had $300 worth of income, so you have $700 of deduction that's left over. Basically, it goes away. It doesn't carry over. The actual expense method is more complicated. You have to figure out the business, the space that you used, but you divide that by the total square footage in the house. So you take that 200 square feet divided by the 2,400 square feet in the house, and that is your business use percentage of the house. You divide your home expenses into direct, indirect, and unrelated expenses. If you itemize your deductions, you can use the deductible portion of your interest and property taxes. Otherwise, you can't use those. If you have your basic telephone service, the first line, if you have a landline or if a cell phone, if that's your basic service, that's considered personal. That's if you have a separate business phone, a business line, those are deductible separately. They're not part of the home office deduction. You're required to take depreciation. So whether or not you take it, you're treated as having depreciated that portion of your house. And it becomes then that portion of your house is not personal residence anymore, it's business property. And so you should go through the effort of computing the depreciation deduction, because you're going to be treated as having taken the depreciation deduction, whether or not you actually put it on the return. And again, the deduction cannot exceed your business income. But in this case, if you have an excess deduction, it does carry forward to the following year. So there's generally the actual expense method will get you a bigger deduction than the simplified method. Mileage and vehicle costs. We've got two ways that we can deduct mileage. This I'm starting now on page 13. So we have the standard mileage rate or actual cost. So the standard mileage rate, IRS publishes the mileage rate annually for the mileage rate that can be used. You can't use the mileage rate if you have 5 or more cars in the business. You can't use it if you've claimed a depreciation deduction for the car other than straight line. You can't have claimed a Section 179 or bonus deduction on the car. And you can't have used actual expenses if you have leased the car. So you can use the standard mileage rate on either an owned car or a leased car. You can use the actual cost method on either an owned car or a leased car. You have to choose, if you're going to use standard mileage, you have to choose a standard mileage rate in the first year the car is used in the business. You can switch later to actual cost, but that first year you have to use the standard mileage rate. If you're going to, you can't switch from actual cost to standard. You can switch from standard to actual. If you have a leased car, you have to use the standard mileage rate for the entire lease period, including renewals, if you want to use the standard mileage rate for leased cars. All right. The actual cost method, you have to determine your actual operating costs, fuel, oil, repairs, registration, depreciation, all those things. Then you prorate those costs between your business use and your personal use based on the miles you drove for business and the miles you drove personally. So you prorate the cost. So if you drove the car, you drove the car 80% for business, 20% for personal, then you take all those operating costs, including the depreciation, and 80% of it will be deductible. The other 20% is not. Parking fees and tolls are deducted separately, and that doesn't matter if whether you're using the actual cost method or mileage method. If you're paying parking or you're on a toll road, you get that deduction is separate from the mileage deduction or the actual cost method. You have to substantiate both the expenses and the miles. Now, if you're with the actual cost method, you have to substantiate both the expenses and the miles. You're going to check a box on the tax return that says you have substantiated that's going to ask you, do you have substantiation for the expenses? You're going to say yes or no. And is the evidence written? And you're going to say yes or no. Those questions are under the penalties of perjury. So if you answer them wrongly, or if you say yes and you don't have that documentation, then the IRS can whack you. So you do have to have substantiation for business miles, whether or not using the actual cost method or the mileage method. You have to say, I drove, this distance for this purpose on this day. Some people use their day timer. They can put it on. They have a spiral notebook in the dashboard of their car. They can put it on. You can put it on your a calendar on the refrigerator. So you can. There's no required way of substantiating your mileage, but you do have to have it in writing, and you want it to be contemporaneous. You don't want the ink to be still wet when the IRS auditor calls you into his office. The final thing here is that commuting miles are not business miles. And so the miles you commute from home to work are not deductible business miles. And so if you're driving from your property out to your tree farm, that's a commute from your home. The tree farm is where the business is. Then those commuting miles are not deductible unless you have a home office. So this is another reason to look at the home office thing. So if you have a home office, even if you don't take the deduction, if you can substantiate that you have a home office, then those commuting miles, now you're going from your work to another to work. And so all those miles from the first place of business and all the miles you drive, then from there are considered business miles, not commuting miles. And so that's another reason to look at the home office, is to avoid, is to basically pick up those miles you drive from home out to the tree farm as business miles. Otherwise, they're commuting. All right. Operating costs. So these are costs. So our operating costs, again, as the first session, we talked about that tree farms and timber has this exemption from Code Section 263A. Code Section 263A requires the capitalization of operating costs for the pre-productive period if you're growing plants that take more than 2 years to grow. But timber operations are not required to capitalize their costs, and so we are allowed to deduct them. All of our costs for silviculture that are not related to reforestation are deductible. So all the costs of fertilization, pre-commercial thinning, timber stand improvement, bud capping, all those things, as long as they're not required to be capitalized as reforestation costs, we can deduct them. And all of our other ordinary and necessary business expenses. So things like dues to OSWA, education, going to tree school, our fuel, our contract labor, our legal and professional fees, all those things are deductible. Meals, I have called those out a little bit because we can only deduct 50% of the qualified meals expenses. Now meals, again, everybody has to eat, right? So we have to eat breakfast, lunch, and dinner. And so those meals are personal. They're not deductible unless they're eaten in conjunction with the business. And there's 2 times when that happens. One is when we're local and we're taking, we're having a business lunch. We're having a lunch or dinner or breakfast with an employee, a customer, or a vendor. And so we're part of the meal, and maybe we discuss business either before, during, or after the meal. But we have a business purpose for the meal because we're talking to or working with an employee, a vendor, or a customer. You have to document on the receipt the purpose of the meal. So who you were with and why this is a business meal. So what did you discuss? So that's a required documentation. We can take 50% of those business meals as a deduction. The other time we can deduct meals is when we're away from home overnight. So we travel away from home overnight. So we're going to a conference someplace, or maybe your tree farm's in another state, or you're going in your, you have a little cabin or something on the tree farm, and you're going there, and that's not your principal place of business. Your place of business is at your home. So if you're doing there and you have your meals, again, we deduct 50% of those meals when we're traveling away from home overnight. The other 50% are non-deductible. Then, of course, wages for employees. Wages, the first dollar of wages you pay to somebody, you have to give them a W-2. So there's no de minimis amount where you're not required to give them a W-2. So you pay $1 in wages to somebody, you're required to give them a W-2. You have all those other costs, the unemployment and workers' comp and everything else for your wages. If you're paying an independent contractor or you're for legal and professional services, you're required to fill out a form. It's a new form. This used to be the 1099 miscellaneous. It's now the 1099 non-employee compensation, the 1099 NEC. This is a new form for 2020 going forward. So if you're paying somebody for services, you're required to file the form 1099 NEC by January 31 of the year following. For any non-corporate taxpayer, so that you bought services from. And I've got some details on this on the bottom of page 15 and some help on that. So again, the 1099 is something we maybe forget about when we're in January, but that's a required filing by January 31st. We have to give those 1099s out. We actually have to file them with the IRS by January 31st. And so before we had to file them with the person we gave the services to by January 31st, we had till the end of February to send it to the IRS. And the 1099 NEC, they accelerated that, so we have to give those forms to the IRS by January 31st. So, and there's late penalties for late filing, and there's also penalties for non-filing if you don't do that. All right, so we've talked a lot about costs, and I'm sure as we've been going through this that you've had questions. If you've had a question, you haven't put it in yet, go ahead and put it in the Q&A, and Tammy is going to come back now and we'll do some questions and answer.
All right, and Tammy Cushing from OSU, the Extension Forestry Business and Tax Specialist, is going to moderate Q&A. So here's Tammy.
Hello, everyone. So we'll, I'm sure, see some more questions come in, but Clint, I can't remember if we've talked really about hobbies and kind of the loss situation, but this question kind of centers around that. And so if we need to refer back to something, we can. But how many years can someone show a loss on Schedule F when the primary product is trees or wood before the IRS decides this is a hobby?
So that's a very good question. So the IRS has a default rule that says if you have income 3 years out of 5, then you are in business for profit. So if you have a profit 3 years out of 5, they're not going to question the other 2 years that you had a loss. Okay, so that's what they call their prima facie. That's basically evidence. So if you've made money 3 years out of 5, then there's no question. If you don't make money 3 years out of 5, then it's the burden of proof shifts to you to show that you're in business for purposes of a profit. We talked about this quite a bit. There's quite a bit of information on this topic in the second class on classification. How you're classified determines how you're taxed. So we talked a lot about the hobby rules there, but basically if you can prove that you're going about this in a business-like fashion, that you have an intention to make a profit, and then in fact you are you do have a profit that you haven't realized because the value of the property and the timber is growing even though you're not harvesting, that all those things can work together. So they look at things like, do you have a business plan, a written management plan? Are you consulting with professionals? Are you doing all the things that somebody in business would be doing, and you just haven't made money yet? Now, the reality is for timber, so this is why it's different for us. If you were running a quarter grocery store, The business cycle for a grocery store is 3 days. That's how many days between what you paid for the invoice and when you get paid by the customer. In a normal business, like that's selling things like an accounting firm or something like that, you have a 30-day business cycle. We pay our employees, and then 30 days later we get our money. So we got 12 business cycles a year, and they're hopefully over 60 business cycles in 5 years that you can at least make money in 3 years. The problem with timber is our business cycle is 60 years long, 40 to 60 years, between the time we put the trees in the ground and the time we harvest. And so that is our business cycle. So and we might have a couple of income events that occur along the way when we do a thinning or something like that. But really the final harvest where we get most of our money is 40 to 60 to 80 years from when the trees were put in the ground. And so because of that, we have one business cycle. It's not possible to make money 3 years out of 5. And so we have to then build a case when the IRS comes, because that's the first thing. Say, well, you've had losses now for 20 years. This is a hobby, you're not making business. But you go back and say, look, the value of the property has grown from this to this. Here's all the things I've done. Here's all the people I've consulted with. So you have to document, carry all that stuff permanently in a file when you get called in. And never say, I just do this because it's fun. Because then it's a recreational activity and they're saying it's a hobby.
Yeah, you nailed kind of my response to many people is don't ever say up front how much fun this is.
Oh yeah,
It really
horrible, awful job. Nobody would want to do this. I can't believe, I don't know why. I must be stupid. Just why do I have this tree farm? I don't know. It's just work. It's
and
all my kids away, right. So
right.
Yeah.
And so many of our landowners, that's exactly where they're at. They really enjoy this. This is a piece of passion work for them, but you can't show that card up front, right? And so it's all again about showing like you're working this with the intention of a profit, that business plan, that management plan, and keeping your records. I don't think we can say that enough, Clint.
Yeah.
So kind of a different question about income from grants, how that's treated, but then on the cost side of it, how are the costs associated with that grant work treated?
Yeah, we're actually going to talk about like cost share and stuff. I think in one of the next 2 sessions. But basically, if you get a tax, so generally the grants, so like the cost share money, generally is taxable when we receive it, and we can offset our out-of-pocket costs generally against that. But there's a bunch of formulas that are involved with that. So it is a complex area, and we will cover it in one of the next 2 sessions, depending on which one we have time to do it.
Great. All right. So this is let me see if I can get this to a question. If we assume that all the herbicides are classified in the same category as fertilizers and other improvements, are we going to treat them as development costs? I think that's what this question is asking.
Yeah. Yeah, I would. So in fact, the silvicultural costs, so those are silvicultural costs, those are development costs. So TSI, fertilization, thinning, and generally, so maintaining out, unless they're reforestation costs. We're going to talk about that next time, but basically reforestation costs is any cost you're required to spend to keep the trees alive. So if you had to spend the money to keep the trees alive and meet the reforestation requirements under Oregon law, so the 200 trees per acre for you to grow in 5 years, all the costs that you have to do to make that happen are reforestation. Anything you do above and beyond that is a silvicultural cost, and it would be a development cost. And it would either be, if you're a business, it would be currently deductible. If you're an investor, it would be then capitalizable. And it would be capitalized not in your timber, but in a reforestation sub-account, which we'll talk about next time.
So I'm going to throw a monkey wrench in this one, right? Because kind of open the door a little bit, starting to distinguish between different costs. So let's talk for a minute about like a pre-commercial thinning and where you would put that on that spectrum.
So pre-commercial thinning would be a development cost. that an investor could deduct or, or capitalize. And the reason for that is it is a stand management expense. The reason you're doing the pre-commercial thinning is to open up the stand to release it for your timber to grow. And so it is something you're doing to develop the stand. You might have some income from it, which would be great. But many times the pre-commercial thinning is we don't get enough out of it to pay for the cost. And so to the extent that you have income, you can net the cost against the income. So that's good news. So if you do a pre-commercial thinning, you send the chips out or whatever, you can deduct the cost to get to zero. Any cost over and above that, though, then would be capitalized or deducted as a miscellaneous itemized deduction when we get miscellaneous itemized deductions back.
Sure. Yeah, I asked that because depending on where you are in the country, you get a very different response on that pre-commercial thin, and it's just whether it's that necessary thing to do or not in the area. So we have someone with a little bit of confusion about the mileage costs. So they're saying they live 3 hours away from the farm. They keep track of all their miles each year, only for the trips I need to be at the farm. So does that mean I cannot take mileage for the miles from their place because they haven't included a home office? So do they have to have a home office to be able to do the mileage?
Yes. That's one of the main reasons why we want to look at the home office. So again, you don't have to take the home office deduction, but you have to qualify, which means you have a place in your home that's regularly and exclusively used for the business. So if you have that, even if you're not taking the deduction, and frankly, if you have that, I would take the simplified deduction. I take that, 100 square feet times $5 and, put it on the return. But because if you're not, then you're commuting. Your place of business is the tree farm. So the same thing is true. So if my accounting firm, my accounting firm is 30 miles away from my home. So all my miles driving from my house to my firm are commuting. I'm driving from my home to my place of business. That's commuting miles. Those are personal miles. Now, if I go from my business out to meet a client and back to my business, that is that's business miles. But so any time I'm traveling for business, but the mileage from my last client back to my home, that's also commuting. And so so that's the big reason why we want to look at the home office is to turn those miles, because for many of us it's a very significant drive to get there, and you want to be able to count not only the miles but also the hours, right? If you've got 3 hours in the car, you want to include that in your hours to get material participation. And so in order to do that, you have to have a home office so that you're driving from work to another job site. And so that's the reason for that.
Great. So I've got a couple of 1099 questions here. So I'm going to ask you the shorter one first. The answer may not be shorter, but the question is whether a 1099 is required for loggers.
Yes. If you look at the requirements, so if they're not operating a corporate form, and most loggers are not. So if they're if they're running as a corporation, it's, Sam Jones Logging Inc., then the answer is no. Because you don't have to send 1099s to corporations or LLCs that are taxed as a corporation. And the only way you would know that is to send them a W-9 and then they would report to you back if they're a corporation or not. So, but it's for services. So if you pay more than $600 in services, which includes parts and materials. So now, this is a good question. So payments for merchandise, telephone, freight, storage, or similar items do not have to be reported. Now, when I think about freight, I think about for a product that I'm receiving, I'm paying somebody for the freight, but so I guess, could we consider the logging or the trucker as freight, taking it out? Maybe. So that could be a good question. Certainly your accountant, your consulting forester, and and anybody else that you're buying services from. The person who's repairing your stuff, that's a service, right? A repair is a service. And so even if, so, and the $600 limit is based on not just the cost of the service, but also on all the parts and other things, materials that they include in the bill. So
maybe that's one we can dig a little bit on. And
yeah, we can
come back.
we'll dig on that. That's a good question, Tammy.
So let's see if this one, if we have an answer today for this one, or if we need to do some work on this one. Regards to the requirement for sending a 1099 NEC, if one rents equipment from a business that has LLC in its name, can one just accept the word of the business that it's taxed like a corp, or is written documentation required? And if so, what does that look like?
Yeah. So you don't have to. So you don't have to do it for rent. So it's unless
This is renting equipment.
So if it's a, so it's different if it's a dry rental or wet rental. So if you're renting equipment with an operator, then you would have to file the form. If you're renting just the equipment only, then you do not, because you're not renting. So you have to rent a service. You have to get a service, and not just the equipment. And so so there's two answers here. So one is that you only give a 1099 if you're purchasing services along with whatever else you're purchasing. So the second question is the LLC. So if somebody has an LLC, 99% of LLCs, or maybe not that many, but it's high number, 80% of LLCs are taxed as a partnership. So you do have to send the W-9. And in fact, it doesn't hurt. I send a W-9 out to basically anybody. If I suspect that I might have to give them a 1099, I send it out, and all they have to do is they just check their status and put their name and send it back. So that's not a huge burden on anybody to do that. And in fact, even if it's a corporation, a lot of people send 1099s out to the corporations too. It doesn't hurt anything. Basically, the IRS doesn't require it because they assume that corporations are paying taxes. And if they're not a corporation, that they're not paying their taxes. The one exception to this is attorneys. It doesn't matter if an attorney is incorporated or not. If you pay them more than $600, you have to send them a 1099 because apparently attorneys don't report their income. And so the IRS makes you send a 1099 to anybody that you buy attorney services from. Doesn't matter if they're incorporated or not. So that's kind of fun.
All right, great.
Accountants, though,
accountants always.
It's not. We're good. We're ethical and we pay our taxes. So not like those scumbag attorneys out there. So.
Hopefully there's no attorneys listening today. So the next question is, how does it work if you transition between various tax statuses over time? So if you started as an investment and then you opt to start a business, how painful or difficult is that? In other words, can you do that?
Absolutely. So it's based on facts and circumstances. And so you can go from being an investor to being a business. Now you can't go back and amend returns. Right, so you're going to go forward with the new status, and so so yes, you would have. So if you're an investor going into a business and you're going to have capitalized costs and other things maybe in there, those capitalized costs carry forward now into the business, and what it means now is that you can start deducting a lot more than you were deducting before, but just for the current year going forward.
And so the final question we have today is it possible to put a value on improvements to natural resources on the property? So fish, carbon, etc. So it sounds more like a valuation question.
So this would be, is this maybe in relation to the hobby question? If you're making, so.
I don't know. That's a good question.
So, I mean, putting a value on things, I mean, you certainly, if you valued the property, it would depend on the purpose why you would want to do it. It certainly isn't income. It's not a deduction. But and so like if you get a conservation easement, they would include those values, and here's the values before and the values after, and maybe, you know, the fact that you have this easement on, you know, in some cases, you know, the value is not, you maybe you say you have all this development that you're not able to do anymore, that reduces the value, but there might also be some additional value that comes because now it's a conservation property, and there may be some other people in the market that are really interested in those properties, and so it would be
So we got a little bit of clarification.
Okay.
It says for assessing change to income or change in income.
Yes. So if you're looking at for how much income that you are getting for purposes of the hobby loss rules, so you want to do that. So yeah, you would look at the increase in value of the property, of the timber, and if you're enhancing some conservation values and they have value in the market. So this is really the issue, is if they have value in the market, if they can be sold, because it is based on a fair value thing. So you wouldn't necessarily have to go out and get an appraisal, but you have to be able to say, here's the value. Now, I've been in audits where, you know, we've had large deductions going forward. And basically what the IRS is going to say is really, they don't want to see the deductions over time greatly exceed the total income, including the increase in the value. That's kind of the standard. Now, sometimes like you maybe go out and you're going to buy a cat, you know, you spend $300,000 on a cat and you have no income and you haven't had any income for 20 years. But you're using the cat to improve the property and develop it and do some other things. And you have enough income as a doctor or whatever to be able to write that cat off, because Section 179 is based on your total earned income. And so you can do that. But you should be prepared to justify that the business, even if it hasn't developed that much income until now, it will going forward. And so this is all just, we've got to tell a good story when we're sitting across the desk from the steel layout auditor and, you know, not get red in the face about it.
So we have a little bit of a follow-up on the 1099. And so let's see if a little bit of facts and circumstances, if we can kind of see if we have an answer on this, on the logger one. So if my agreement with the loggers is 60-40 split, for example, logger works with Hampton, Hampton pays 60% to the landowner, 40% to the logger, then does Hampton prepare the 1099 to the logger?
Yeah, no, you're required to do it because 100% of the income is your income. Hampton is just acting as a pay agent. And for the logger, for sure, you give a 1099 if they're not a corporation. For the trucker, maybe not. But for the logger, absolutely. The logger is providing a service. And so the logger, if they're not operating as a corporation, you would send a 1099 to, even if Hampton is splitting the proceeds, you're also going to record, because you're going to report 100% of the proceeds on your return and the logging cost. The only time you wouldn't do that is if you sold the standing timber to Hampton and Hampton hired the logger. Mm-hmm. Then you're reported on as a 631B transaction.
Yeah, so I think what some of this shows, and I hope some of you are hearing this, is how that contract is set up, how you're selling is really going to impact where the income is flowing and who's going to report what and what's issued. So that's a really important decision to understand up front. Mm-hmm. So Clint, that's all we have for today. So I'm going to pass the baton back.
Great, thank you, Tammy, and thanks everybody. I'm looking forward to the next one. We're going to talk about capital expenditures. Those are the big ticket items. How do we deal with those?
Great, thank you so much. That was amazing, Clint, and thanks for the Q&A, Tammy. I shared a link in the chat again to our website where all the past videos, slides, and handouts are posted for you. Thank you so much for participating in Oregon Small Woodlands Association Tax Series. OSWA members pay dues that support events like this. So if you're not yet an OSWA member, now this would be a great opportunity to show your support and join OSWA so we can continue to provide landowner education like this that helps you manage your woodlands. You can join by going to our website, www.oswa.org, and clicking on join/renew. With that, thanks again for joining us today. We'll see you next time.